Credit cards feel like a win. They let you buy now, pay later, and collect perks along the way. Cashback, airline miles, hotel upgrades. It seems like you're getting the better end of the deal. But here's the real question. If credit card companies are giving you all these benefits, how are they still making billions? It's not just about interest. There's a whole system working in the background, and every swipe you make fuels it. In this BytePlain video, we're breaking down exactly how credit card companies make money and how you can avoid being part of their profit. Let's start with the basics. A credit card is a short-term loan. When you swipe your card at a store, the store gets paid instantly, but not by you. Your bank or credit card issuer fronts the money. Then you get a statement, usually at the end of the month, and you have a short period, called the grace period, to pay it back. If you pay in full, you avoid interest. If you don't, the company starts charging interest on the unpaid amount month after month. So in theory, you could borrow money for free, but only if you never carry a balance, never miss a payment, and never slip up. And as you'll see, credit card companies are betting that many people will slip up. The biggest source of income for credit card companies is interest on unpaid balances. If you don't pay your full balance by the due date, you'll get hit with interest charges, often between 18 and 29% APR depending on your card. APR stands for annual percentage rate. It's the yearly cost of borrowing, expressed as a percentage. But what really matters is how often it's applied. Most cards calculate interest daily, not yearly. So that 20% APR, it's not one big fee once a year. It's small amounts charged every day on your current balance. And if you're only making the minimum payments, you're in a cycle of paying interest on top of interest, called compounding. Example, if you owe $2,000 on a card with 22% APR and pay just the minimum, you could end up paying over $4,000 in total over several years. That's double the original debt, and all of it is profit for the issuer. According to the U.S. Federal Reserve, credit card interest income in the U.S. alone exceeds $100 billion every year. That's just from people carrying balances. It's the single most profitable part of the system. But interest isn't the only way credit card companies make money. Even if you pay your bill in full every month and never pay interest, they still earn. That's where merchant fees come in. Every time you swipe your card at a store, the business pays a fee to process the transaction. This is usually between 1.5 and 3.5% of the total. It's called an interchange fee. Let's say you spend $100 at a shop. The shop might only receive $97. The remaining $3 gets split between your credit card's issuer and the network, like Visa or MasterCard. The network acts as the middleman. They make the connection and process the payment. The issuer, your bank, takes the bulk of the fee. Multiply this by millions of transactions per day, and you get billions in profit. That's why some small businesses charge extra for credit card use or offer discounts if you pay in cash. They're trying to avoid those hidden swipe costs. So even if you're a perfect customer, never late, always paying in full, your spending still earns the credit card company money, just from a different part of the system. Then there are the fees that come straight from you. Even before you owe interest, you can still be hit with charges like annual fees, common with travel or rewards cards, late payment fees, often $30 to $40, foreign transaction fees, around 3% when spending abroad, balance transfer fees, when you move debt from one card to another, cash advance fees, borrowing cash from your card often comes with immediate interest and a fixed fee. While not everyone pays these, millions do, and these charges add up. Credit card companies design some of their cards to be fee traps. High limits, unclear terms, and fine print create situations where people accidentally trigger penalties. For banks, this isn't a flaw, it's a feature, a carefully engineered revenue stream. Now here's the part that confuses most people. If credit card companies make money off you, why do they offer rewards? Why do they hand out cashback, points, airline miles, and gift cards? Because rewards drive more spending, and more spending means more merchant fees. Plus, statistically, the more people swipe, the more likely they are to carry a balance. It's simple math. Let's say you get 1% cash back, but the merchant pays a 3% swipe fee. That means the card issuer earns 3%, gives you back 1%, and keeps the other 2%. They also know that rewards build loyalty. Users will stick with one card and spend more just to hit the next perk tier, even if they're taking on debt to do it. So those free perks, they're not really free. They're baked into the system and mostly paid for by people paying interest and fees. Let's take a step back and look at the players in this game. There are two big roles in the credit card ecosystem. Issuers. These are the banks that give you the card, like Chase, Capital One, or Citi. Networks. These are the companies that process the payments, like Visa, MasterCard, American Express, or Discover. Visa and MasterCard don't lend you money, they just process the transaction. But they earn billions per year from merchants and banks using their network. American Express and Discover do both. They issue cards and run the network, so they get a bigger slice of the pie. Each of these players profits in different ways, but they all benefit from you using your card more often. Now here's where it gets real. Credit cards are designed to be easy to use, but also easy to misuse. People often spend more than they can afford, pay only the minimum, miss due dates, ignore how interest builds. That's how they get trapped. You start with $500, then $1,000, then $3,000. Suddenly you're stuck paying hundreds in interest, and your minimum payments barely make a dent. This isn't rare, it's the business model. In fact, some banks rely on this behavior. They know a large share of profit comes from a small group of people who carry debt long-term. So how do you avoid being part of that profit stream? Always pay your balance in full. Set up automatic payments to avoid missing due dates. Never spend more than you can pay back within the month. Treat rewards like a bonus, not a reason to buy. Don't carry a balance for points, it's not worth it. Used responsibly, credit cards can help you build credit, earn perks, and stay secure online. But misused, they can quietly drain your money for years. So how do credit card companies really make money? 1. Interest from unpaid balances. 2. Fees paid by the stores you shop at. 3. Direct fees from cardholders. 4. A reward system that encourages you to spend more. It's a brilliant, complex, and incredibly profitable system. And now, you know how it works. So next time you swipe your card, you'll be one step ahead. Thanks for watching BytePlain, where we explain tech and finance in plain language. Subscribe for more videos like this and take control of the systems around you.